Good morning, everyone. You're very welcome to our webinar this morning. Pension Options Unpacked, Real Perspectives from Financial Advisors. This morning's session will be hosted by Larissa Feeney, CEO of Kenor. We're an award-winning accountancy and company secretarial firm with a client-centric and technology focus, supporting SMEs across Ireland and UK with compliance, payroll, outsourced financial admin and bookkeeping and management accounts. Joining her as our expert guests are David Crowley, the founder of IFC Finance, advising corporates, SME, professional firms, and private clients across Ireland and the UK with a strong focus on corporate pension strategy and long-term financial planning. And Stephanie Graham, we're hoping, is joining us as well. She's just running a couple of minutes late. She's Managing Director of Smart Money Financial, who specializes in retirement planning, savings, and investments. I'll stop sharing now and hand over to you, Larissa.
Thanks, Christina. Good morning, everybody. Thank you for joining us. So today's webinar, as Christina has just told you, is about unpacking your pension options. For those of you who are not familiar with the rules around auto enrolment, that's incoming on the 1st of January. We did do a previous webinar on this topic a couple of weeks ago. So that webinar talked about what the rules are, what you need to do, what employers it applies to, what employees it applies to. If you weren't at that webinar and if you're not sure of the rules, we'll put a recording. Christina's going to put a link to the recording in the chat so you can watch that yourself in your own time. Today's webinar is all about, okay, I know what the rules are. I know what my obligations are as an employer. What do I do next? Oh, there's Stephanie. Good morning,
Good
Stephanie.
morning, folks. Sorry about that.
No problem, no problem at all. We're just starting. So before we kick off, I'm just going to ask Stephanie time to catch your breath, and I'll just ask David. David, if you wouldn't mind, give us a little introduction to you and what you do.
Sure, yeah. Good morning, everybody. I'm David Crowley, founder of IFC Finance and GroupRisk.ie. So I'm in the business too long, probably 30 odd years or so. I run a number of corporate pension schemes, as Larissa has alluded to, and corporate group risk schemes. So we also look after quite a number of private clients in the pensions advisory, group risk, general investment and life cover space. So inheritance tax planning. So that's about all I can say. I suppose we're based in Fitzwilliam Square in Dublin too. We have a small advisory practice and we get our business by referral.
Super. Thank you, David. And Stephanie, you've caught your breath there. So if you can maybe tell us a little bit about what you guys do in Smart Money.
Yeah. Good morning, everyone. Stephanie Graham. I'm a certified financial planner and I'm director of Smart Money Financial. We're based here in County Monaghan. We have been up and running now for just over 4 years now at the moment, and I actually started off with a background in accountancy, so I've got quite a good area of expertise on both sides of it for businesses and both personal individuals, which is what we would predominantly work with locally and further afield.
Okay, super. Okay, thank you both. Okay, so this is a really short webinar. It's only 30 minutes, so I'm going to get straight to it. Really, I suppose what we're looking to understand is sitting where we are today, so it's almost the middle of December. If I am an employer and if I don't have arrangements in place right now for auto enrollment, where do I go and what do I do? So maybe Stephanie, I'll start with you if that's okay.
Yeah, so I suppose with automatic enrolment now at this stage, we're kind of in that, we're in an in-between window at the moment. The government announced there, I suppose, a month to 6 weeks ago which we knew that already that there would be a look back period, but what they, I suppose, issued was that with regards to the look back period, that anyone who wants to be in a private scheme as opposed to automatic enrolment, it needs to be in November's payroll if monthly paid, or from December, the month of December, if weekly or bi-weekly paid. So that left a lot of people, I suppose, in a window maybe where they were missing kind of that position to get into a private scheme before the automatic enrolment commenced. But that being said, that doesn't mean that they're going to be in the automatic enrolment only and they don't have other options come January. It just means that they may fall into it just for a couple of weeks, but then they can set up a private scheme and go from there and let it kind of, I suppose, override it would be the best word to use there, if their preferred scheme is the private.
Okay,
Mhm.
so what? So just so I understand,
Mhm.
the government announced that if you weren't in a private scheme by November payroll, if you were
Mhm.
monthly paid, that you were going to the employee was going to automatically be enrolled in My Future Fund, which is the government auto enrollment portal, on the 1st of January. So that window
Exactly.
is now closed.
Yes.
Um, and so if you weren't in a private scheme, or if your employee wasn't in a private scheme by the November payroll, you right now you have no choice. Your employee is going to be put into auto enrollment. Is that correct?
You will fall into that, yes, exactly. So what they're doing in that look back period is looking at the last 13 weeks and defining anyone who is eligible, and that eligibility is obviously the between age 23 and 60 and an earning over €20,000 per year. And then obviously within that eligibility, they will go through all payroll softwares and see through the revenue system, has anyone got a pension scheme going through their payroll that leaves them exempt from the automatic enrolment, even though they fall
Okay.
into being eligible. So
Okay. Okay. So the employee will be automatically enrolled right now, but as I
mhm,
understand it, it's not forever if you don't wish it
no,
to be so. Right.
no,
Okay.
no. From what we can see is, and obviously finding this information isn't always very straightforward as everything's
Mm.
changing so quickly. But if someone, there is obviously, you must be in, if you want to be completely exempt, you must be in for 6 months. But if you set up a private scheme in the next, say, couple of months, it will override the automatic enrolment as long as there is a pension in place for said individual.
Okay. David, which is better? I know this is a very difficult question to answer, but for the employer, this is from the employer's perspective, of course,
Mm.
because all of our registrants are employers. Which is better, to proceed with the My Future Fund option or to set up a personal pension for the employee at this stage?
Well, the key thing in auto enrollment versus a company paid pension scheme is that if you're if you have a high staff turnover and your employees leave within 6 months or whatever the period of time, probation period of 6 months, the employer loses the pension contribution that they have put in for that employee. So from a cash flow point of view, it's much worse to be in the auto enrollment uh, scheme than in your own scheme. If you have your own scheme, you generally set a 2 year vesting period for each member of staff. And if the person leaves before, 6 months after their probation period, the employer gets their money back and the employee gets their money back. So it's far, far better to have a corporate scheme that you control. You also control, or the employee controls the investment portion of that money. So wherever they want to invest their money, the employee controls that. So it's
Okay.
much better for the employee as well.
Okay. Okay. So from what you're saying then, even if today's date the employer doesn't have pension provider, that they should continue to do so and to get that set up, allow the employee to be enrolled in My Future Fund, and then allow the new scheme to kick in as and when in 2026.
Exactly. More so because you control the scheme and you control the rules around it from the employer point of view. You also don't suffer the cash flow problem of when people leave before the 2 year vesting period applies. So if they leave after a year and a half or a year and 9 months, you've lost, as an employer, you've lost all those contributions into the AE fund that ordinarily, if you had your own scheme, you can take it back. So it's quite a significant cash flow from an employer's point of view.
Like, I think that's for me certainly. I think that's the
Yeah.
point that everybody has to be aware of, because for 2 years, if you have your own scheme, like in a lot of industries, 2 years or less would be normal, actually.
Mm.
And that's certainly the way in terms of the future of work. That's the way it seems to be going. Less time with an employer, so it would appear to be prudent to have control over that element of contributions. Certainly. Is there anything else, Stephanie, that we should be thinking of?
No, I think David kind of hit the nail on the head here. And that's, I suppose, the advice I would be applying to a lot and giving to a lot of clients is the control is the huge thing here for people, and the additional advice. So it allows you to decide what you put in. It allows the employer to decide what they contribute to their employee scheme, as well as that cash flow thing. They can control, the staff incentive there, that if they stay for more than 2 years, that they actually can keep their contributions and maybe get bigger benefits if they kind of stay on with it as well. I think a lot of people have been discussing the tax relief point, and I do have to agree with that. The automatic enrolment, there's no tax relief applied, but there is a government top up into the pension fund, which I suppose essentially is a 33%. So they have kind of the argument there of the 20% taxpayer or the 40%. Yes, it may come across as more beneficial to go the automatic enrolment if you are the lower rate taxpayer. But I would say that that does need to be considered quite strongly, because tax relief isn't the whole thing and the whole dynamic with regards to a pension scheme. You could be getting limited on what you're contributing to your pension by going automatic enrolment. That 1.5% may not be sufficient for retirement and retirement planning. So I think to avail of the tax relief shouldn't be the deciding factor as to whether you choose automatic enrolment or a private scheme. And I think a lot of people, it's been talked about quite a lot in news and different things. So I think that's a strong factor for people to consider.
And sorry,
Okay, so
Larissa, can I just add in there that apparently it's going to be announced mid-December by the government that regardless of who pays the contribution, that the employer must ensure that 3% goes into the employee's pension. So if the employee can't pay or won't pay, or it's not in their contract to pay, the employer then has to cough up 3% instead of 1.5%. So that's a significant cash flow issue for employers, that ultimately they will lose that money because the employee gets to keep all that money in their fund. So that's a further cash flow issue just from an employer's point of view.
Okay, that's really interesting. So there's 2 points there. Stephanie, the point you made was that the cap on contributions. So let's say, for example, as an employee, it's in my interest to pay more than 1.5%.
A lot of circumstances, yes.
A lot of circumstances, depending on my age and all of that, right? So under the auto enrollment rules, are you saying that I can't pay more than 1.5%?
No, it's it's set in stone. So 1.5, and it will increase over the 10 years. Eventually will become 6, but it will be standardized across the board, 6% finally after that period.
Okay. So that's really important for those employers out there. If you have employees, it may not be suitable for them depending on their age. Maybe for younger employees that have 30 or 40 years of working ahead of them, perhaps. And then, David, the point you made there, if I understand you correctly, is if for whatever reason the employee doesn't want to pay their 1.5%, and let's say that could be for many reasons, but let's say it doesn't happen, then it falls on the employer.
That's right, yeah. And if it's important here because a lot of contracts have already been issued to employees, signed, paid, they're there a couple of years. So does that contract allow for the employee to be forced into a pension? And the government, or as I say, they're expected to announce mid-December that regardless of whether the employee pays or not, 3% has to come from the employer into the pension for that employee. So that's, it's a huge burden on employers, especially, if you have 20, 50 employees, it's a big burden on employers.
I think, David, it goes back to lack of control again. So if, as you said, if the employee can't, say they can only put in 0.5 or 1%, it falls back on the employer, and they can only predict so far. They don't know what next month, next year holds with regards to what employees are capable of paying.
And go back to the younger folk, Larissa, the younger folk have their priorities to save for a house, to put a bit of savings away, etc. They're not necessarily able to pump up 1.5 or even, as Stephanie says, to get up to 6%.
Yeah. I think that's another downfall with the automatic enrolment. They've now recently issued that you can suspend your payments for 1 to 2 years if the case may be needed. But I don't think that's fair also, because if someone can maybe pay a little bit less for a period, as you said, you've maybe a young couple, kids, mortgage, and they're going, oh my goodness, I can't afford X every month, but I can afford slightly lower than that. But they either suspend, so they either put in nothing or they put in all. So there's no waiver there of premium for a specific period or something like that. And I don't think that's fair either. So once again, it's limited.
Okay, God, it's a minefield, isn't it? It is a minefield. And say on the point of capping at 1.5, that's not the case if the company has its own pension scheme. You can contribute whatever you want. The employee can contribute whatever you want. So as you said, definitely, it's the flexibility, it's the
Yeah.
control you have under a private scheme that you don't, or yes, but that you don't have under the
Hmm.
government backed scheme. Okay, that's clear. Thank you. I have one question in from Sarah that has two parts to it, so I'll ask the first part first. Sarah says we have a private pension scheme set up for our company in ROI. Not everyone decided to enroll. Those who didn't, will they automatically go into my future fund in January's payroll?
Yes,
Yeah.
once you're registered with the portal as the employer, you'll
Okay.
automatically be enrolled.
Yeah.
Okay, okay. Sarah, that answers your question very clearly. On your second part, does Kenor do this, or do we need to action something before? You will need to action something before, Sarah, but if you, I'll get somebody to get in touch with you just to talk that through with you so you know what to do. Okay, thanks, Sarah, for your question. By the way, if anybody else has any questions, please feel free to pop them in the chat there. Two questions did come in before the webinar, so I'm just going to ask you those now. So the first one is, do I still need to have a pension provider for employees? So I'm guessing that this is coming from the other side, perhaps somebody who doesn't have a private pension or a company pension and is looking at just my future fund. You can just have my future fund
Mhm.
if that's what you wish. Is that correct?
Yeah, exactly. It's the employer's discretion if they want to facilitate a private scheme in addition to the automatic enrolment and give their employees that choice. And if that was the case, it would be advisable, I suppose, to speak with a broker or someone in the knowledge that they can guide them in the right direction of what company's best and charging structures, etc.
However,
So
if whoever asked that question is on the webinar, I think it's clear that that's probably not the best option for the company or the business in terms of cost efficiency. So absolutely seek advice on that. Sorry, David,
Hmm.
I interrupted you
yeah,
there.
sorry. We run a number of corporate pension schemes, and so what some of the companies are doing, they're bringing in a sort of a lower limit for all new entrants, regardless of whether you're on probation or not, and they have it at say 2% and 2%, so that it's slightly better than the AE.
Yeah.
And the employee has 4% going into their pension scheme. So again, but it's the company controlling it. So therefore, if the employee doesn't pass the probation, the company gets their money back and the employee gets their money back. So
Okay.
it's not a loss making situation for anybody in that situation. So
And David, I assume with regards to them company schemes, would be quite similar with myself. You, as you said, they're starting off at a lower, that 2% tier, but that allows the company and directors to, depending on maybe roles within the company, managerial, admin, different roles can be on different percentages to allow for incentives to allow for that as well.
yeah,
So if there's
generally, generally what we're finding is that the tier goes from if you're there more than say 3 years, the contribution then goes to 5 and 5, or if you're there more than 5 years, it's 8 and 8, or so, it's just across the board. It's different. Depends on the company, depends
yeah,
on the
yeah.
budget. So yeah, it doesn't generally go directors. I mean, sometimes it can. Sometimes it can be layered by directors, managers, etc. Down further down, but it's very
Hmm.
flexible. As you know yourself,
Exactly, yeah.
corporate pension schemes are entirely at your discretion as to
Guys,
how you
which
flex.
is another good point, I suppose, for an employer who maybe has a big team behind them.
Yeah, absolutely.
What are the benefits of my future fund then? Why, is there any benefit? Is it weighted in favor of the employee? Is that where if you were an employee, would you be choosing my future fund? But I take the cap on contribution side. I get that there's no
Mhm.
flexibility there. But is there any benefit to it?
I think the main benefit to My Future Fund and the whole auto enrollment is that it's driving an awareness for pensions
Yeah.
across the board, across 40 to 50-year-olds who've never had a pension, across younger people, across employers. So I think generally the 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 setup of the scheme is a good thing. But going back to your point and Stephanie's point, having control by the employer, I think, is the key, because it's a cash flow issue. And especially if this announcement comes to pass in mid-December, where 3% has to be paid, or 3.5 has to be paid, half will be paid by the government. But if that comes to pass, it's a significant cost on the employer, where the money is gone because you can't get it back.
Mhm.
Completely. And the second question that came in was comparison between private and state pensions. So maybe for those who don't who maybe wouldn't be familiar with what the difference would be between a private pension and a state pension? That's to either of you.
Well, the state pension, the non-contributory, the contributory one is just slightly over 15,000 a year, and the means tested pension is about 14,500 a year. Up to 14,500, but obviously it's means tested. So sorry, what was the question?
The comparison between a private and state pension. So
And
I suppose
then a private pension, if you have a fund of 500,000 or a million built up by the time you hit 60, 65 or 66, whatever the pension age is, you take your 25% tax-free cash. So say it's a million, you get 250,000. I think it might be limited to 200, but you take 25% tax-free cash, say it's 200,000, and then you invest the rest into what's called an approved retirement fund. The approved retirement fund has to pay you 4% a year. So 4 8 of 32, so you get 32,000 from your ARF fund. So that there's it's another explanation to people, but it's obviously a lot better if you have a bigger fund in your private pension, which you control, because you also control the investment choice options, which can get you a much bigger growth spurt.
And I'll also add before I ask what. Oh, sorry, Stephanie, go ahead.
I was just going to say, I suppose with the private and the state pension, what the real aim with it is you're bridging the gap between the state pension and say the current income that you're on at the moment, or maybe the income you feel necessary for retirement, which they say is around 2/3 of your current income at present. So it's really to bridge that you're not retiring for whatever reason at 65 or 66 and being limited to 15 grand per year and maybe not being able to live the life that you maybe had dreamed of, anticipated, or having to let go of a couple of additives that you maybe getting your hair done, for example, if you're a woman, them little things that come with that we take for granted.
Not a challenge you have, David.
Not a challenge. I was just about to say that.
Thank you both. Okay, there's two more questions in that we'll run through. Olivia says, if we have an employee where the company pays into their PRSA monthly direct debit, i.e. not through payroll, the employee does not pay through the payroll into their PRSA, unsure if they contribute at all, how can we stop auto-enrollment in January, or how best to deal with this?
Sorry, you go ahead, Stephanie.
I was going to say that can still go through the payroll, but there would be no employee contribution with regards to it. So I suppose it can still be on a pay slip, and that's probably the only thing that they need to change is just have it visible on the pay slip under a pension contribution.
It's an employer only pay, is that right?
Mm-hmm. It seems like it, yes. Yeah.
Being a company owner, is that it, or?
No, it looks like it's an employee. The company pays into the PRSA monthly directly. So directly pays PRSA, but not through payroll. So definitely, Olivia, get that added to the pay slip, which is actually something that we had to do in Kenora with a couple, where for whatever reason they weren't on the pay slip, the company was paying it directly. So that one's easily corrected from that perspective. And does that mean that auto enrollment doesn't happen then in January if it's on the payroll?
Has to be on the pay slip.
Yeah, and as long as there's sufficient contribution going in, so
over the limit, at or over the limit, threshold, right? Okay, perfect. Ian has that. So, Olivia, hopefully that answers your question. But if not, let us know, please. Ian also asks, I have a single person consultancy with a director's pension for over 2 years, but this isn't currently appearing on payslip. How do I get these connected so revenue don't assume no pension in place? Similar question.
Did he say director there?
He's a single person consultancy with a director's pension. Yeah.
Yeah. So any company directors and self-employed people aren't eligible for the automatic enrollment. So there'll be no automatic enrollment pensions being applied to them. So they're excluded. Okay.
So there's no impact for if you're a director, you don't have to worry.
Yeah. Class A employee only. Yeah.
Okay. So Ian, if you look at your payslip, you're more than likely paying Class S PRSI on your payslip. So that would indicate that you are proprietary director in your business and therefore you don't have to worry about auto enrollment. And for everybody else, if you have other employees, which I don't think you do, but for everybody else, your employees will be paying Class A And it's class A then that's eligible for auto enrollment. What about the other classes, David and Stephanie? What about class M, for example? Or do they also are eligible for auto enrollment, or is it just class A?
I actually had this come across this query the other day. Yes, because
Okay.
they're not. It's once it's class S or self-employed, so I suppose everything
Okay.
else falls under that. Class M, am I right in saying they? I suppose comes down to maybe they don't pay PRSI or they're
Yeah.
certain ages. So in that case, class M probably wouldn't be included because they're either over the threshold or under. But the other classes should fall within it. This is similar to class A.
Okay. 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 Um, okay, look at that. We're out of time already. 30 minutes goes by so
Time
fast,
flies
doesn't
very
it?
fast, doesn't it?
Especially when you're
Time
late.
Are you
flies.
enjoying yourself? Hmm?
I want to keep us to time. So first of all, thank you all for coming. Thank you for asking all those questions. David and Stephanie, thank you so much for sharing your expertise. It is a minefield. I
Mm.
appreciate you giving us your time and answering your questions. And thank you, Christina.
Thank you so much,
Thank you very
everyone.
much,
Have a
everybody,
good
for
Thanks,
day.
stepping up.
everyone. Bye.
Good
Bye.
day.
Thank
Bye
you.
bye.
Bye.
Bye bye.
Bye.